Module 2 of the Finance Fundamentals course covers the topic of financial markets and the different types of financial instruments available to investors. This module is critical to understanding how businesses and individuals can invest their money and generate returns. In this essay, we will cover the key sections of Module 2 and provide examples where appropriate. First, financial markets. Financial markets are where buyers and sellers come together to trade financial instruments. There are two primary types of financial markets: primary markets and secondary markets. Primary markets. Primary markets are where new securities are issued and sold for the first time. Companies can issue new stocks or bonds in primary markets to raise money for expansion or other uses. For example, a company may issue new shares of stock in a primary market to raise funds for a new product line. Secondary markets. Secondary markets are where securities that have already been issued are traded among investors. The most common secondary market is the stock market, where investors can buy and sell shares of publicly traded companies. For example, an investor may buy shares of Apple stock on the secondary market in the hopes of selling them for a profit in the future. Second, stocks. Stocks, also known as equities, are ownership shares in a company. When investors buy stocks, they become part owners of the company and are entitled to a portion of the company's profits. Stocks can be bought and sold on the stock market, and their value can fluctuate based on supply and demand. Common stock. Common stock is the most common type of stock, representing ownership in a company. Common stockholders have the right to vote on issues such as board elections and major company decisions. They also have the potential to receive dividends, which are payments made to shareholders from the company's profits. Preferred stock. Preferred stock is another type of stock that typically pays a fixed dividend. Preferred stockholders do not have voting rights, but they have priority over common stockholders when it comes to receiving dividends. Third, bonds. Bonds are debt securities that companies, governments, and other organizations issue. Investors who buy bonds lend money to the issuer in exchange for a fixed interest rate. Bonds can be bought and sold on the bond market. Corporate bonds. Corporate bonds are issued by companies to raise money for expansion or other uses. They typically offer higher interest rates than government bonds but also come with a higher risk of default. Government bonds. Government bonds are issued by governments to finance projects and pay for government programs. They are considered less risky than corporate bonds but offer lower interest rates. Fourth, mutual funds. Mutual funds are investment vehicles that pool money from multiple investors and invest in a diversified portfolio of stocks, bonds, and other securities. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. Equity funds. Equity funds invest primarily in stocks and other equity securities. They are typically more volatile than bond funds but offer higher potential returns. Bond funds. Bond funds invest primarily in bonds and other fixed income securities. They are typically less volatile than equity funds but offer lower potential returns. In conclusion, Module 2 of the Finance Fundamentals course covers the different types of financial instruments available to investors and the markets where they can be traded. Financial markets, such as primary and secondary markets, provide opportunities for businesses and individuals to raise and invest money. Stocks and bonds are two of the most common types of financial instruments, and mutual funds offer a way for investors to diversify their portfolios. Understanding these concepts is critical to making informed investment decisions.